Good morning and welcome to this Monday, December 13th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're getting off to start of a week that's going to take us into the second half of December. This is historically a period of time when the market does well. It doesn't guarantee us anything, of course, but if you follow odds and you like to track probabilities, I would say that the odds are that we see higher prices over the next couple of weeks as we move toward the end of the year. And then January will be interesting because it has a very strong correlation. The performance of the market in January historically has a strong correlation with the rest of the year. I call it the January effect. And as the market goes in January, so goes the rest of the year. For the most part, not every year, but normally if you get off to a good start in January, it tends to portend a nice year. And the opposite also holds true. When you struggle during January, the tendency is that the market has a rough year ahead. Not necessarily a big sell-off, but it could just be that, average gains or less than average gains, maybe slight move to the downside. We've got an event that's going to be coming up. We're going to talk about it more here in the next couple of weeks, but it's our Market Vision 2022 event, which will be held on Saturday, January 8th. Putting together the speakers and everything now. We should have everything lined up here in the next few days to a week. We'll get that information out to all of you. But that will be an interesting, that's going to be a really interesting event because we've had such big moves to the upside now for 2 straight years. Remember, back at the bottom of the pandemic, the S&P 500 was at 2191. We're at 4,700 now. We more than doubled the last 2 years. And when you look at the history of secular bull markets, I mean, yeah, you go up over long periods of time, but you don't go up at this kind of rate every year. So, I'm looking at some things that are going to be pretty interesting, I think, going into 2022. And we'll talk about that again on Saturday, January 8th. So make sure you mark your calendars for that. But let's talk a little bit about Monday, December 13th first. And so for those of you who are new to Earnings Beats, welcome. Certainly appreciate having you stop by. Hope you enjoy the show. Couple of things you can do if you're new to Earnings Beats and not really familiar with how we look at the market and our approach. If you go to our website, earningsbeats.com, and you scroll down, you'll find an area right here where you can subscribe to our free Earnings Beats Digest newsletter. I publish this every Monday, Wednesday, and Friday, so it's 3 times a week. One of the cool things about it is that we really, it's not a long newsletter. I mean, you're going to read it and go through it probably in about a minute. 2 paragraphs and a chart is usually what we're talking about. So, 1-2 minutes tops, you can probably look at the chart and get a general sense of what we're talking about. But we like to focus on areas like relative strength, earnings, gaps, candlesticks, those sorts of things are going to be featured quite often in the newsletter, really to drive home some of the key points that we think are important when you're looking at investing and, trying to plan for your financial future. Hopefully the stock market's part of that. And that's the part that we really try to focus on. So anyhow, if you go over to earningsbeats.com, scroll down, you'll find that. All it takes, name, email address, hit that subscribe button. Literally, we have tens of thousands on our newsletter. So we'd love to have you join us, join our community. It's also a great way to get information about any kind of special events. And sometimes we do free events. In fact, many times we'll do free events and we reach out to our entire community. So if you are, if you do like the show and you like some of the things, the blog articles that I write and so forth, probably makes sense to be a part of our community here on the Earnings Beats Digest, just to have access to some of those things. Anyhow, let's get going on Friday. A little bit of a mixed market. I mean, for the most part, we saw everything up. All 11 sectors were higher. Our major indices were higher, but it was bifurcated in the sense that there was definitely strength in certain areas and not in others. Large cap did better than small cap. If you look across at the Dow, up 3/5 or 0.6%. The S&P, which was up almost 1%. The Nasdaq up 0.75%. These are where you're going to find more of your larger cap names, and they did really well. Look at the mid caps, and we're up less than 0.1%. Small caps are almost perfectly flat, up 0.02%. So there was definitely a skewing on Friday, more towards the large cap, more towards growth, or at least a little bit more back towards growth, and not as much as probably we would like. But we did see some, movement back toward growth, and that's why we saw the Nasdaq not have a bad day. Looking at the AD lines down here on the bottom, you can see it seems like, just looking at the ADs, the Dow, S&P, and Nasdaq are either at or approaching all-time highs, or in this case 6-month highs, while the AD lines on both the mid caps and small caps, look at this, down close to 6-month or at 6-month lows. So I mean, just looking at that tells you that the market continues to maybe move more toward the large cap and less toward the small cap. I don't think that's going to continue forever, but it has been going on now for quite a while. And so that's going to be an interesting, that could be an interesting argument for 2022. Are these small caps and mid caps going to bounce back on a relative basis? Their charts aren't bad. I mean, when you look at this, you can see we're still in an uptrend here, still in an uptrend here, even though in the short term, we've definitely taken more of a hit than the other indices. We're still holding above support. So I don't think there's any reason to panic in these areas. It's just that the market's not favoring these groups right now. Sector-wise, I just pointed out here, technology, all 11 sectors up again on Friday. I can't tell you how many times now over the last 2 to 3 weeks, either all the sectors have been up or all the sectors have been down. It is just this constant yo-yo back and forth. And then, of course, leadership within that has been fluctuating back and forth. So it's not really been easy to keep track, of the best areas and where you should be from a trading perspective. From a long-term perspective, I wouldn't really be doing a whole lot. I'd just be sticking with the market. I think the stock market's going higher. Could we have rough patches? Of course, we're always going to have rough patches. Every secular bull market has rough patches. But if you're in it for the long haul and you don't want to follow the market on a daily or even weekly or monthly basis, you just want to be invested when it looks solid, I would say, in my opinion, it looks solid. I would be invested. Now, short term, got a little different ball game there. And 2021 has been, personally for me, I think one of the more challenging years. Even though we've continued moving higher and it seems like it's just like all the other years, it really hasn't been. I mean, with the inflation news out there, the move back and forth between growth and value has been quite substantial. And depending on what part of the year you've been in and which area of the market you've been in, growth versus value, you could have done really well or really poorly. The timing was really everything. And again, that's from a trading perspective. Long-term buy and hold, just get in your major indices, the ETFs that follow the major indices, and just kind of follow along. I think that makes a lot of sense for a long-term investor. Anyway, technology on Friday was up over 2%. Staples, consumer staples, defensive group, 1.7. Energy, more value, 0.75%. Then we had discretionary up 0.7%. And then materials up 0.6%. So again, all in all, looks pretty good. I think the one thing that's really holding the market up is technology. Technology is the biggest part of the S&P 500. It's the biggest part of the Nasdaq. And you can see as we move up and we break out to new highs, here's the good news. We're breaking out to new highs in technology, which I think is one of the most important areas of the market, if not the most important area. The bad news, it's the large cap tech. I mean, if you're watching Apple and Microsoft make up huge portions of both the S&P 500 and the Nasdaq. So when you're seeing Apple and Microsoft performing well, that can mask a lot of maybe not so great action. So just keep that in mind. It's not always just what technology is doing, but it's also, what those large cap names are doing within technology, because sometimes they lead and the rest of the market kind of gets left behind. I think that's a little bit of what's going on right now. And certainly when we look back over here to the mid caps and the small caps, I think that really explains a lot of what's been taking place in the market lately. All right, 10-year Treasury yield. Let's get an update here. Not really looking for much in the way of economic news today. However, tomorrow we get another big inflation report. It's going to be the PPI. Now, personally, I look at the CPI more than the PPI, because the producer price index, that can affect obviously, companies more than individuals. The CPI is how much gets passed along to the individual. So a lot of companies making a lot of money. So if producer price index is going up, sometimes they just eat it at the company level if they're doing well. But if they're not, or they need to manage their profits, then they'll start to pass it along to the consumer. So when we see it in the CPI, for me, that's the number that I think is more important and one that I think the Fed watches more closely. And we saw that one on Friday. And there's no doubt inflation is moving up. And in fact, I don't think we're going to see inflation top out until probably around May or June of 2022. So if you're expecting these numbers to just all of a sudden start getting peachy, that's not going to happen. But I do think it's this bubble that has just been going through every area of the market, including the market itself. And I think these inflation numbers are much higher than they're going to be a year from now. But between now and then, we're going to have market reactions to this inflation news. And like I said, I don't think we're going to see the worst of it until we get well into 2022. That'll be a lot of what I talk about at Market Vision 2022 on Saturday, January 8th, because I think that's going to play a big role in the first half of the year. Looking at the 10-year Treasury yield right now, this is one of the reasons why I will say that I'm confident that inflation is not a big problem long term. We've now been dealing with a lot of inflation news since probably the middle part of February of last year. We were sitting, I don't know, maybe 1.3% middle of February. By the end of February, we were up at 1.55, 1.6% on the 10-year Treasury yield. Here we are 10 months later with worse inflation news than we had back then. I mean, it's continued. I mean, now we've got the highest inflation rate that we've seen since back in the 1980s, probably, or at least back in the 90s. And yet, with all that news, the 10-year Treasury yield is still sitting exactly where it was a year ago or 10 months ago. Doesn't exactly scream runaway inflation to me. I mean, forget about what the Fed's doing, whether the Fed's raising rates. The 10-year Treasury yield, the bond market's independent of the Fed. Bond market can anticipate what it believes the Fed should be doing. It's not showing us anything. So I still believe that there's, very little risk at this point that inflation's a long-term problem. Is it a short-term problem? Yeah, of course it is. But as long as the market believes that's all it is, I don't think it's going to have a big impact in the overall market. Now, what we are seeing is that difference between value and growth. When inflation fears ramp up, the growth stocks get hit. I mean, I've seen some, we're going to talk about one in the 3 you must see later today, got absolutely crushed on Friday. These growth stocks, the beauty of them is that when earnings are going up and they're raising estimates and rates are low, they can absolutely explode to the upside, because as you raise estimates and as you raise growth rates and then discount those future earnings and future cash flows back using low interest rates, the valuations explode to the upside. Now, the downside is when that growth restricts in some way, or the market anticipates that there could be a problem, because then it's like months and months, maybe even years and years of gains literally are gone in about a week, sometimes in a day. And I'll show you one of those later in the 3 you must see. But anyway, all of this is, needs to be factored in, but we still have low rates. So I still think the big picture is the market goes higher with some issues along the way. But I believe we're going higher, and that therefore long-term, I think you stick with this market. Short-term, put on your crash helmet, strap into your seatbelt, and just prepare for the ride, because it's probably going to be a roller coaster, not just in the market, but between growth, value, large cap, small cap. I think we're going to be in for this probably at least through the middle of next year. And then I've got a different forecast for the second half of next year. All right, let's move on to talking technically. I just want to go through a couple of the main charts that we like to look at, the key indices. So here's the Dow. I mean, you can't really say we have anything other than uptrend in place. Some might look at this and say, yeah, but look at that head and shoulder, coming down, neckline. There's your head coming down to the right side of a neckline, right shoulder. Looks really bearish. Well, we do have an uptrending neckline, left to right. And right now, the left shoulder, if you call this the left shoulder over here, and this is the right shoulder, got the right shoulder up above the left shoulder. That usually doesn't happen. I mean, normally you don't have upsloping shoulders and upsloping neckline. That's an uptrend. Normally what you see is a head and shoulders starts to tilt and roll over. So I like to see a lower neckline, and I like to see a lower right shoulder than a left shoulder. Now, it doesn't mean that this isn't a head and shoulder. If it goes down and breaks down on heavy volume, then yes. I just don't believe it's going to turn into that. Based on the way this pattern's set up, I just don't think we're going to go back down and take out that neckline. And history would kind of bear me out on that because, as I mentioned at the top of the show, second half of December tends to be very strong. But we do have another inflation report tomorrow, so just be on the lookout there. And the worst part of December is the early part of this week, the 10th to the 15th. Today's the 13th, so you got to get past Wednesday historically for that second half bullishness to kick in from a historical perspective. Again, we could be up next 3 days and then down the next 2 weeks. I mean, history doesn't guarantee us anything for the future, but if you enjoy, what history has done and the tendencies, which I do, I do follow it. I don't trade specifically off of historical data, but if I like the market technically, and then historically, that also lines up with my belief of what I think the market's going to do, it just gives me more confidence. So I use it as more of a secondary indicator, historical tendencies. All right, S&P 500, similar, but look at the neckline. All of a sudden, this neckline doesn't look like a neckline, not even close to the low we saw back in October. So, S&P 500, I think, looks a little better. And by the way, in case you didn't notice, that close on Friday was the highest close in the history of the S&P 500. Another all-time high close on Friday. So we've gone from, I think I wrote about it in one of the articles, or at least thought about it or talked about it. I write so much and talk so much, so I keep track of where or when. But I don't know that we've ever seen a stock market where the S&P 500, where the volatility index, let me show you the VIX. 6 trading days ago, the VIX was at 35 and change. That is usually marking a major bottom in a secular bull market advance. And it did it again, by the way. I mean, we talked about it. I wrote about it. Been saying a lot about it in the daily market report, talking about it there. When you get fear that ramps up to this level, usually you're getting to or pretty close to a market bottom. So we got to 35. 6 days later, we're at an all-time high. You've got that old Wall Street adage, climbing the wall of worry. I mean, I don't know if we've ever climbed one that fast. 35, panicked, Omicron variant, inflation. Oh my gosh, here we go to the downside. Okay, forget about that. 6 days later, all-time high. That's kind of the craziness that we have in the market right now. And another week, maybe by the end of the year, we could be back down here at VIX lows, 14, 15. It wouldn't surprise me at all. So, and if you look back, same thing happened back in January. Had the huge spike, and literally 10 days later, we were back lower than we were before the spike. That's kind of been the history, and that's how the market operates. All right, so let's see, what else did we have here? I think with the S&P, maybe take a quick look at the Nasdaq here. And actually, before we look at the Nasdaq, I want to pull up a 60-minute chart because I do like to follow 60-minute charts. And here I see a bull flag or flagpole with a flag here. So this is a bull flag pole followed by the flag and a breakout. Now we do have overhead resistance intraday up at about 47.40 or in the 47.40s. So we're going to have to negotiate that. But breaking out to an all-time high close and then looking like this on the 60-minute chart, I think we're probably heading higher technically. It's what it looks like to me. Let's pull up the Nasdaq 100, the NDX, which, by the way, is changing a number of its components today. So don't really have a whole lot of time to go into that right now, but there are about, I don't know, maybe 5 or 6, 7 stocks coming out, others going in. So that's going to change the makeup of the index. But here again, on the 60-minute chart on the Nasdaq, move up, pulled back a little bit more, but I think as long as this low, this gap open right here, you can see we went down and tested it on Friday. I think as long as that holds to the downside, I would be looking at this as near-term move to the upside. Also moving up, it looks a little bit like an inverse head and shoulder to me, which is coming down the left shoulder, neckline, head, right side of the neckline, coming down right shoulder. Breakout above about 16,450, I think would be pretty bullish for the Nasdaq 100. All right, next up, I wrote an article on Saturday. Don't know if you saw it, but this was talking about inflation and just some of the things that, I see. I get really frustrated by the media because the media doesn't explain anything. The media just puts these headlines out there to scare everyone, to get them to click, and then just talks about how bad things are. Oh my gosh, it's just so horrible. Everything's so bad. This is our first stint with inflation in 30 or 40 years. Could it be the start of something horrible? Sure. But let's let the charts tell us that, not the media. Media wants to tell you, there's a train wreck going on all the time. So look at the charts. And so what I did when I went through this is I just pointed out 2 major things that are driving inflation right now. When we went into the pandemic, of course, we shut down everything. Nobody wanted to see anybody. Nobody wanted to be within 6 feet of anybody. And businesses shut down. We shut down the entire economy. Well, when you do that, of course, demand goes right through the floor. And you got a ton of supply because you've been making all these things and nobody wants them now. So what happens? Prices go down. There it is. This was prior to 2020. I think it was over like the last 40 years. I think we saw a drop in the core consumer price index like 3 times or 4 or 5 times. I don't know what it was. We did 3 months in a row. Unheard of. A year later, guess what? Now we're looking at a period that is being compared to the period where things fell apart. So of course, March, April, May, June just absolutely goes crazy to the upside. Is that inflation? Or is that just the economy getting jump-started again? I think it's just kind of like making up for this move to the downside. Now, when we get into 2022, when we get into March through June, those are going to be our comps. These are the things that are going to fall off in our annual calculation. And so it's only going to be, June through May. So unless we continue to have really high inflation levels, and that's going to be important to watch, but as we start to back off, which I think we will, you're going to see the annualized rate really drop off as we move into the spring of 2022. What does low inflation do for stocks? I'll just leave it at that. The other thing you want to watch for, or one of the things you want to watch for with an inflation period, is gold. Gold versus the S&P 500. Here's the 12-month rate of change in inflation right here. Here's what gold's doing relative to the S&P 500. Boy, everybody's just pouring into gold right now, aren't they? Really petrified of inflation. I'm being very sarcastic, by the way. Nobody's going into gold, not on a relative basis. People are still going into stocks relative to gold. Why? Why would you do that with inflation running rampant? Well, they tell you one thing. The lips lie. I don't think the charts do. So you got to be careful what you're listening to. Then you got the US dollar. Again, if you have inflation, the dollar gets eaten alive. You should be selling the dollar aggressively if you really believe inflation is going to be a problem here in the US. So here we go. There's the inflation. And the dollar's going up over the last year. The dollar's going up while inflation's surging. wait a minute. They're telling us inflation, this is the worst in 40 years. Shouldn't we be seeing, the dollar tumbling? We're not seeing it. And then you got growth stocks versus value stocks. So here, what I used was the Nasdaq versus the S&P 500. Nasdaq doesn't really have any financial companies, not traditional financial companies, banks, and so forth. And then you got the S&P 500, which has all kinds of, it's just much more diversified between growth and value. Nasdaq 100 is mostly growth. So I like to use this as my, growth versus value barometer, at least at the large cap level. And you can see Nasdaq over the last year gaining ground in a pretty big way versus the S&P 500. And yet inflation's going up. Now, we did have a little scare at the very beginning, but we've come back and set a new high. Just think about, I don't even know what to say, to be honest. I mean, I'm flabbergasted when I see media talking about the hype, hyping up inflation and talking about how this is the worst and how it's going to get worse. And, I saw, oh my gosh, one of the guys on CNBC, I saw there was a news article that came out on CNBC, and I actually clicked on it and read just because it's a well-known analyst. I can't even think of his name right now. But anyway, he was saying how the Fed has totally screwed up this transitory talk about inflation. I don't think they have. I think maybe they miscommunicated it, how long it would last. But I do think it's a transitory thing. I just don't think it's a 3-month thing. I think it's probably I think it's going to take another 8-9 months probably for this to really work its way through our system or start working its way through our system. And that's what all the charts are telling us. So do what you want to do. I'm not here to try to convince you. I'm not a registered investment advisor. So I have no license to tell anyone what to do or to advise anyone. All I can do is teach and look at the things that I think are important and pass them along. And then hopefully you can make a little bit more of an informed decision. If you believe that inflation's a problem, by all means, take whatever precautions you think is necessary. I'm just pointing out the fact that what we're seeing in the media and what we're seeing in the news is not what I'm seeing on the charts. So do with that, what you want. All right, let's move on. I want to just talk about a couple of upgrades and maybe a downgrade. First up, upgrades. We got Coca-Cola being upgraded today. Watch this overhead resistance. I think Coca-Cola is getting ready to make a breakout. I think Coke's a great long-term company. It hasn't been a great performer over the last, 6 to 8 months, mostly just sideways. But this is a great long-term growth story. And a breakout above these recent highs, I would certainly expect it at some point. Maybe we get that today. I think it looks good. Network Appliance was upgraded today. This one's another one that's sideways consolidating. I think it's a great company. Breakout above 95 is what we're looking for here. Pull back down to around 85 is a great entry. Another really highly volatile stock that's being upgraded today is Task. This is a stock that ran from 27 to 85 in 2 months. Just probably too much. And now it's come all the way back down. It got an upgrade this morning. This is one I'd be careful of, but at the same time, if you like taking on risk, if it gets back through its 20-day moving average, I think that would be an interesting development technically for the stock. The downgrade I wanted to mention was Merck. Merck, look at this stock. It's been doing nothing for the last month. It's fallen from 91 down to 72. Now it's getting a downgrade. It's got support, I'm going to say 67 to about 71, this whole range in here. So I think with the downgrades, probably going to take us into an area where a long-term investor might be interested, value investor. I like to trade momentum. I don't like to trade based on value. All right, let's move on. Earnings spotlight, just very quickly. Just want to run down a few names that'll be out later this week. We got Lennar in the home building area. On Thursday, we got Adobe, a big software company, going to be reporting, and FedEx will also be reporting on Thursday, as will Accenture and Rivian, the new EV company. So got a lot to look forward to there in earnings. Just not a lot in terms of volume, but there are a few big companies you want to pay attention to. And now we'll move on to the 3 you must see, and let's wrap this thing up. First up, I wanted to go through and show you ePay. ePay, big move here, looks great. Needs to get a breakout. I want to just mention, when you look at this chart, you see this big candle here, recently another big candle here, another big candle here, heavy volume on those candles, these hollow candles, starting to look to me like accumulation. And if you pull up go toward the bottom of this chart right here, notice the AD line's breaking out, even though we haven't broken out in price. So it does look like there's accumulation. When I pulled up the weekly chart on it, it's got a lot of tops at here at about 55 and just opened, by the way, market did. We got to get a close through 55 on a weekly basis. And on a daily basis, we can go back to that daily chart and then just set it up for 2 years and get a little bit better idea on a daily basis. But yeah, I mean, 56, 57 looks like we've got to negotiate that level. But then things could be looking up. Net, this is Cloudflare. Huge move. Now, Cloudflare has been under a lot of pressure. Notice the negative divergence that's set up here on the high. Higher highs, lower PPO. That told us momentum was slowing. Net's been coming back. It's getting close now to the breakout level. It goes through periods where it's weak, and that generally has set up some pretty good opportunities to get in. Stock was, what, 220, 230 not that long ago. Now it's 141. And that's just in a month. That's how fast some of these growth stocks get hit, when they're out of favor. But I think longer term, I think this is a nice stock. And I would have no problems beginning to build a position. Although, again, I'm not really I'm a momentum. I'm not really a value trader. I'm not trying to catch bottoms. But this is one that longer term, I think, has held up pretty well. So this could be an opportunity. The last one, and this is the one I was mentioning at the top of the show, where all of a sudden, you just have all these gains for a few years, and then they just get wiped out. And these small growth names are, something that, where this can happen. So Everbridge, which really hadn't done much the last 18 months or so, sideways consolidating, all of a sudden it was up to 180 back in February. Now it's at 60. But look at the 5-year weekly chart on the stock. It just went up, up, up until finally putting in this sideways consolidation, which ordinarily I would expect a break to the upside, sideways consolidation. But there's also a little, left shoulder, neckline, head, right side of the neckline, right shoulder, and there's your breakdown on the head and shoulder. So, I'm not normally looking for head and shoulder breakdowns in a secular bull market, but we got one here. And it just illustrates, when you are investing in individual growth names, how volatile and how scary it can be sometimes to have one earnings report kind of change the course of a stock's future. Everbridge here, to me, completely now in trouble. It looks a lot like DocuSign looked. Remember DocuSign with the big gap down a couple of weeks ago? We came back up, that top of gap resistance failing to hold there. Now it's starting to roll back over again. These growth names, when they start talking about slowing growth, that's not good, because their value is based on that growth ahead. It's not based on their cash on their balance sheet. These companies, these growth companies, don't have much in the way of balance sheets many times. It's all about their growth. That's what value is based on. So when their growth slows, there's nothing to hold them up. Anyway, let's take a quick look at the market and wrap this thing up. We're starting off the week, slight losses now. We had futures up. I didn't even talk about futures, but futures were up slightly this morning, but we have moved into negative territory now. I think probably, the inflation report on Friday, we've got another inflation report tomorrow. Historically, the 10th to the 15th of December. I don't know. This first couple of days this week, I'm just kind of sitting back watching, see what happens. But I do really believe we're going to see another move into year end, just because, as we start to see more and more folks going on vacation, we get away from these inflation reports. The further they're in the rearview mirror, market's not thinking about them as much. I think we probably will see a move to the upside. I mean, it's not 100% chance, but I'm going to say, I think probably 75% chance that we're going to see higher prices at the end of the year than we're seeing now. And by the way, I remember I mentioned the Market Vision 2022. At Market Vision 2021, I said, and the S&P 500 was at 3750 at the time. I said I thought we'd gain 1,000 points on the S&P 500. and finished this year at 47.50. Right now at 47.02. The year before at Market Vision 2020, that was right before we started the pandemic. The S&P 500, I believe, was around 3,100. I said the S&P would go to 4,000 by the end of the year. We went down to 2191, finished the year at 37.50. We got really close to that 4,000 level, even after having a pandemic. So I do have some really strong thoughts about how 2022 is going to go. So if you haven't been to one of these events, I'm going to likely have a few speakers coming over from Stock Charts. It's going to be another great event. Just mark your calendar now. It'll be in the morning of the 8th, January 8th, Saturday, January 8th. Maybe carry over into the early part of the afternoon, but if you can't stay for the whole thing, it'll be recorded. More and more will be coming out about that here over the next couple of weeks, so be on the lookout for that. All right, that's it for me. Market looks like it's selling off just a little bit more, but let's see how it goes today, and then we'll monitor the rest of the week. Everybody have a great day. Tomorrow, you can catch me over at Stock Charts TV at 9 a.m. Eastern. All you have to do is 9 a.m. Eastern, click on this link right here, and you'll catch the next episode of Trading Places Live. Have a great day, everybody. Happy trading.